Hello, everyone. Welcome back to the Frivolity. Of course, we just had our free broadcast there a few minutes ago. I don't know whether anybody, actually, a few of you that are over there now. I know you guys were part of the free broadcast, so I hope you got some value out of that. But as you can see on our screen, things are moving in earnest. I'm not exactly sure what the headline was, so let's see if we can maybe dig it up here. You know what? What we'll do is while we're waiting for the talking feds, why don't we put this down in the corner there? And as soon as that video kicks in, because that looks like it's just some sort of cheesy, politically correct advertising that they're doing. At least we can show in here in this window what actually happened. So there we are. Fed interest rates 5.5 actual. Previous was 5.5. So I'm getting the impression that they left rates unchanged. But clearly the market was, I don't know whether the market was expecting that or did they say something in the message that wasn't expected or something? I have to remember how, okay, I'll get rid of that bookmark, so it gives us a little bit more room to work with. When the video does come on, we're obviously gonna have to change that up there, right, Chris? So we're just sort of getting things started here. Just do as best as we can. Here is a brief sort of econ summary of what's come down the pike here this morning. And I don't know, maybe we can just click right on this Fed. Let's see. Federal Reserve kept the target rate.
7 members or governors were nominated by the President of the United States.
Oh, where's that coming from?
Governors are appointed for 14-year terms.
That's not me, is it?
Governors.
Oh, it is. Wow, that sounded like a pad if I've ever heard one, eh? Of them. They're not male, female, they're a they, right? Isn't that how it works? Anyway. Federal Reserve kept the target range for Fed funds rate at a 22-year high at 5.25 to 5.5. So they are already sort of intonating that they're fine with 5.5. 25 basis points hike in July and in line with market expectations. Isn't that interesting? Another blip, blip, blip. Maybe I better put this away. Trading is locked, so we don't need that open now. Something is bleeping and blopping as I go here. I'm not quite sure what it is. So I can put that away as well. Okay, the one market here that has kind of messed me up here recently, of course, is they got rid of the euro dollar market, which I loved dearly. Now all of my other quotes are all messed up. They're using this SOFR thing now. Federal Reserve Bank of New York. How ironic, eh? I'm not quite sure which one is the best one to use. There's so many, eh? 30-day average SOR, 1 month SOR future. Actually, this is probably what we want. 3-month SORFR. Oh, there we go. All right, so everything's in line. Okay. So interesting. As soon as I fixed that, all these other markets came back in line. And now where's our little interest rate bug? There we go. Okay, so that's actually a pretty picture. What do we got right out of the gate? We have the US dollar index rallying smartly. Policymakers said that recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have slowed in recent months but remain strong, and the unemployment rate has remained low. Inflation remains elevated. Remember, Mr. Powell, one of his main tenets was, I want you to feel pain. So maybe he's not seeing the pain that he wants us to feel yet. I don't know. They always say never trust the first hour of trading following Fed announcement. And I see fans of TRI are already posting my don't trust the first hour statement there in the YouTube chat. So I think Adam is going to be an excellent trader. In fact, actually, I was even chatting with him this morning. He's talking like a professional trader. So very proud of Adam. All you got to do, sir, just put lots of miles under your tires and you will do perfectly fine in this world. I see David. Hello, David. David's giving a wave. Nure, my German bodybuilder. Could probably bench press all of us put together and tell the Fed to go screw themselves at the same time. We got Juan there. Hello, Juan. And we got Cotter. Welcome back. Actually, you better be careful. Google will probably give me a copyright strike. And I think, if I'm not mistaken, Cotter, you're over here in the Zoom call with us as well. I have a couple other people in the Zoom call, of course, as always. Let's give a shout out to Chris. He's such a boss, running and producing and directing these shows. And I don't think he gets enough acknowledgement, although I would like him to become more of a part of the public broadcast. But man, he sure is reluctant to come on and talk to you guys. Anyway, we'll break his media cherry one of these days, turn him into a superstar if he wants. Maybe he does want. I don't know. As you can see, we have this matrix. I'll just describe what's on the screen here. So we have the US dollar index in the upper left. And of course, this isn't real. This it's not real, so disregard it, right? This is the index, or it's like a basket of the euro, the Swiss franc, the British pound, the Japanese yen, the Australian dollar, Canadian dollar. I'm sure there's a few other currencies in there as well. And all it really is just what is the relative value of all of these currencies, like the basket of them. This is the US dollar index. So as you can see on this panel, we have the euro, we have the Swiss franc, we have the British pound. So that's basically your European contingent. And we have the Japanese yen and the Aussie dollar. That's our Asian contingent. Could probably also throw in the New Zealand Kiwi in there as well. They used to call the Kiwi sort of the poor man's way of playing the currency markets. It would pretty much move in lockstep with the Australian dollar, but it's a lot cheaper. And we have the Canadian dollar, and you could argue Aussie dollar, Canadian dollar are great commodity proxies, as well as the Swiss franc, because for the longest time, Swiss franc used to be on their own. They were neutral, and they had a ton of gold all buried in their vaults and stuff. And of course, they were the banksters of the world. So they were a great proxy on gold prices. Then the Swiss joined the euro, and then they noticed that their currency was getting ripped apart and devalued as the pigs nations were just destroying the value of all the hard work that the Northern Europeans do. And as a result, the Swiss said, screw this. And that was, I think, in probably, I can't remember the exact year, but I think, if I'm not mistaken, it was like 2000, maybe 2018, somewhere in there. They said, we want to be on our own again. So they went on their own. And if you are interested, Swiss franc's a really good proxy on what gold should do. So you might argue that these three are sort of our commodity currency proxies. But as you can see, Swiss franc and euro also move very close. In fact, all the European currencies generally move in unison. I suppose we could probably, over the coming 5-10 years or so, I wouldn't be surprised if the Mexican peso actually becomes a more realistic investment vehicle. I get the impression that the powers that be would like to extricate themselves from the Chinese nonsense, as long as Winnie the Pooh is basically a totalitarian dictator. I mean, clearly the banksters, they're not going to like that. You notice what happened when the South American countries, when they all went down the path of dictatorships, the US banksters just destroyed them. I think Argentina's still trying to recuperate from all that. So I wouldn't be surprised that you actually see down the road the Mexican peso. Maybe we even need to start adding that to our quote boards, but I get the feeling that the Mexican peso is going to be pretty important currency going forward. And I also wouldn't be surprised that, like the euro, which is like the German mark and the French franc and a whole bunch of other currency blocks and stuff all merged into one. I wouldn't be surprised if you have the Canadian dollar, the Mexican peso, and the US dollar actually all merge into one trading unit. And I wouldn't be surprised if the banksters actually, that's part of their sort of great reset plan for the next 10, 20 years. There used to be a unit called the Amero that was really popular in the late 90s. And it was weird. 2000 came along and George Bush Jr. and all those guys did all their nonsense, and that whole conversation went away. So we might hear more talk of the Amero as time goes by, but I've said repeatedly, commodities are definitely a short here. And ironically enough, the commodities never did really get their due. This thing over here stole its sunshine. We were even joking on the site recently about how gold, and actually somebody was saying, man, Brian, you went off on a hell of a rant yesterday on gold in the day trader room. We actually had some people that hadn't been on the site for a while. They popped into the day trader room and they're Brian's rant. And they're like, business as usual. Nothing's changed here. So anyway, okay. So those are the currencies. Following the interest rate markets. Unfortunately, we lost our euro dollar market, which was just such a great sort of cheat sheet as to the path of interest rates and what the market was expecting, the corporate interest rate market. And I wouldn't be surprised if Big Brother 1%, we want to control you, you will own nothing, and you will be our cocksucking slaves. Thank you, Klaus, and all that nonsense. I wouldn't be surprised they wanted to kill the euro dollar market because that represented free market capitalism, and we don't want that in the 21st century. The scuttlebutt, of course, was that because of the Moppets, if you know what a Moppet is, then you'll remember how bad the British banking, what they did through prior to the great financial crisis and all that, and the way that they really screwed people over through the LIBOR market. They had to kill the LIBOR market. So that's one of the reasons why the euro dollar market collapsed. But anyway, now we're dealing with this SOFR, SOFR. I think it stands for short-term overnight funding rate. I think that's what it stands for, something like that. I don't know, frankly, if this is even going to be usable for us now, because it's not free floating. It's a set rate, but you can see, obviously, it had to be knocked back down with the Fed talking about 5.25% to 5.5% now. That target window. And I wouldn't be surprised if usually in an election year, and maybe write this down if you have your journals and you're like, hey, is this guy going to actually tell me something that's something I can actually learn from? Usually in an election year, the bankster cartel, the FOMC, whatever the hell you want to call it, they don't want to be perceived as influencing the election. So they would prefer to sort of recede into the background, which means they're probably going to want to raise interest rates as much as possible before we get into 2024. And I think that's what the whole sort of scuttlebutt is, especially with November. I think it's probably a foregone conclusion. The only problem here, I suppose, is that I think interest rates are going to continue to remain very firm because the economic data is, inflation is not going back down to 2% the way, of course, that they would like. And it's going to be a long, slow slog. And I was trying to outline to the site members, and actually, I guess in the free video as well. There are socialist, idiot, communist leaders out there that still are runaway printing money. And as long as we're in that environment, that's Milton Friedman. And I spent some time in the free video this morning basically outlining that the US and the US Federal Reserve, they're trying to get in front of this money printing and try and reduce the money supply. And so I think you do see the inflationary pressures abating a little bit. But we got the Communist Party of Canada. There ain't no stopping with their money printing there, the bastards. So, the Fed's almost got like an uphill battle. They can't lower interest rates as long as all these communist countries in this sort of Western G7, G12, whatever you want to call it, world keep printing money. So, here is the Americans. They're trying to get some sensibility to their money printing. And, it'll be interesting here when the Fed starts talking. Of course, as soon as the Fed does start talking, I'll shut the hell up. And Chris will put on the actual Powell speech here in the bottom corner here. But you can see that they are trying to rein in money supply. I mean, this isn't really that huge of a move anyway, but at least they're trying. And I do actually see a little bit of pricing pressure coming back into the US market. Here in fucking communist Canada, nope. I mean, the guy, and this is the terrible part about parliamentary government is they're just, the leaders become like little despots, and the guy literally figures he can do whatever the hell he wants. And who cares what happens to the country? Once he's done, he's gone. I mean, you don't hear, and this is the odd thing about parliamentary governments. You don't really hear about, we had our previous leader was a gentleman by the name of Stephen Harper. You never hear anybody talk about him. And, prime minister's gone by, same thing. It's all exactly the same. So anyway, blah, blah, blah. Trying to explain why the inflationary pressures are still very strong. It is interesting to see that the Europeans have been trying to raise interest rates, but I think they even paused recently too. So they all have to raise their rates to the Americans' rates. Now, what should happen in this scenario is if they don't, and they don't get control of their money spending and they just keep printing money, this current Canadian currency should like literally collapse. I mean, it's already pretty bad. Under that Stephen Harper guy, the Canadian currency was actually worth more than the US currency. It would trade it at a premium to the US, kind of like how the euro is. But since Mr. Little Despot Dictator popped into the market and took over, Canadian currency has just been in free fall. And I don't really, I mean, you see the M's. This is just what is this? This is a 3-minute chart. So, I mean, it's just a short term picture. But we could spend lots of time looking at that Canadian dollar and how bad it looks on the price charts. So, anyway, looks like I guess I can't click on that, and that stays on picture, so can't click on this stuff. But it does look like the bond market is relatively okay. There is the rate decision right there, bang, and a knee jerk, all prices right across the board fell. It's interesting how on the shorter end of the curve they're falling, but then you get out to the longer end of the curve, it doesn't look so bad. That's going to be more interest rate or yield curve inversion, and probably just to give you a graphic of what the hell that's going on there. I haven't seen anybody else actually be able to pull this off. So these guys are basically the source for getting really good usable dynamic yield curves. And that's this tool right here. But you can see inverted. So the short end is going to stay still relatively steep, going out to 5 years, right? We saw that the 5 years coming down here. There's a little bit of a reprieve here between the 10 and all the way out later on, like the difference between the 10 and the 20. As I said, the longer dated bonds are not responding as badly, and they're kind of flattening out. Interesting image here. One guy I've been suggesting to people at the site to watch. I think he's become quite popular, I think, on social media and in investing channels. George Gammon. He had a pretty interesting take on short-term interest rates and when a potential recession could potentially come. And that's about somewhere between about 6 months and a year following when the Fed is done raising interest rates. Now, I might say that this, you hate to use the term, this time it's different, but I might say that because of the US election, you might find that things are a little bit maybe delayed because of the US election, but at the same time, too, the U.S. is in a this election is going to be different to say the least. And I'm ironically enough, the one saving grace for the market is that if Mr. Trump does come piling back into the driver's seat and win an election here next November down in the States, you saw how the market reacted when he won last time, right? That's the capitalists taking over. And of course, the market loved that. And the copper market, professor of economics, just exploded higher. And economics, frankly speaking, half of the reason why the US economy is as strong as it is because of all the policies Mr. Trump put in place. Very pro-business, pro-USA. And another reason why I can be as bullish of USA Inc. as I am. And of course, all the cycle theory that I teach students is all based on 17 and a half year fear greed cycles. And we are in actually a 17 and a half year greed cycle, which means we should be US dollar bullish, or more importantly, euro bearish, and definitely commodity currency bearish. And I also think to a certain degree, Asian economies and currency bearish as well. So anyway, we'll see how it goes. So interest rates, as we said, the big problem here is yield curve. And when does the yield curve imply recession? And I think that's coming down the pike here. We might actually have like a violent dip here at the beginning of the year. And then by the time we actually get around to the election, maybe they're going to manufacture another sickness to try and shock the market. I don't know. It's tough to say. But something has to happen here that needs to break before the Fed can actually start even consider lowering rates. And I don't know what that's going to be. It's tough to say. Other markets we got on the screen here, good old Bitcoin. And actually, I was surprised to see, for whatever it's worth, I actually strapped on for sort of demonstration purposes on the site. And we got a nice little bullish bot that's set up here heading into this event. We got 1 low, 2 lows, 3 lows, nice double bottoms, market's working higher, and we're up a whopping 12 cents on the trade. Woohoo, party! So you can see there was the rate announcement, and we'll see how this plays out. Live by the sword, die by the sword. It's not really that big of a trade. It's like 0.1 Bitcoin. So you can see risk reward ratios. Well, we'll see what happens here. But that's actually not looking too bad. And the interesting thing about this is, of course, good old TRI's algo actually flipped back bullish over here. So TRI, the algo itself is still long. And really, I don't see any reason to change this in the short term until we actually start getting some breakdowns here. We did potentially have an M top that came in here, but you notice they really did not want to close it below these levels, and they did not want to close it below that level. So I'm kind of thinking that we're probably not going to roll over bearish until we take out that low right there. There's a bunch of support in here. Every time the market dips into these lows, just some buyers just turn up, right? And turn it back higher. And we'll see what happens. Only time will tell. They always say don't trust the first hour of trading following a Fed announcement. So we might find everything's all over the map. It is interesting to see how Ethereum actually is looking very uppy here. And I did notice in the previous Fed meetings that Ethereum actually works really, really well as a sort of leading indicator. So keep your eyes peeled on this little chart right here. And then how do things like the stock market and the commodities markets act with Ethereum? Like I said, I've often seen that this actually acts as a pretty good leading indicator. So you notice that it was starting to catch a bid and starting to move up. And now all of a sudden, mysteriously, look how the stock markets are starting to come back here. So, all right, down here, right beside where we'll see Powell speaking, we've got the Dow, the S&P 500, the NASDAQ, and the Russell 2000. So, and actually, I beg your pardon, these are the currencies. Here's the stocks. So as I said there a moment ago, Ethereum puts in a bottom, starts going for it, and you can see the stocks all started to turn back up right at the exact same moment that Ethereum turned up. So they all seem to be pointing higher. Of course, we just started this episode, so an hour from now, everything can look completely different, but we'll see what happens. Our basic metal commodities here. So we've got the gold, the silver, and the copper. And like I said, probably the number one market to follow as to see what the hell the economy is going to do going forward is the copper market. They always call copper professor of economics. Then on the flip side, energy prices. And usually what happens in an economy is energy is the leading commodity on the cycle. They always say cost push and demand pull. So costs, things like energy, go up, and then businesses have to pass on those rising costs onto consumers. Consumers, of course, clamor for higher wages to pay for the higher costs. The demand for higher wages, of course, is inflationary. And so as a result, gold moves up with those demands from labor for more money. So interesting how we have the energy markets pretty soft here. They're not really that happy. And then we have, so here is light sweet crude, unleaded gasoline. And then finally at the bottom here, we have natural gas. And usually they say, all right, well then usually Brian should shut the hell up. And we'll leave the conversation at that. Let's head on over and we should do an over under. How many chapows do we hear today? And does anybody want to have chapows, baby? Okay, Brian being silly. If you could, Chris, I would appreciate if you could give me that link that you have for the meeting. I wouldn't mind running it on my end, and I'll just listen to what he has to say there. Potter said he had
my colleagues
Jay
and I
Powell's
squarely
baby
focused
this
on
morning.
our dual
There he
mandate to
goes.
promote
All right, so
maximum
he's
employment
speaking.
and stable prices for the American people. We understand the hardship.
Could you DM me that link?
Price stability is the responsibility of the Federal Reserve.
Could you DM me
Without
that link?
price stability, the economy
you
does
place
not
the sugar
work
on
for
it?
anyone. In particular, without price stability, we will not achieve a sustained period of strong labor
Thank you.
market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace, and so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%, 4% over the 12 months ending in August, and that excluding the volatile food and energy
That's basically nothing.
core
3.8 to
prices rose
4.1?
3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainable.
Wow, look at crypto go.
Has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power,
Nice.
especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. Range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a half percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. It is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more
does not
benign
want his
inflation
baby
outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal child care funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question by deciding to just maintain the rate and await further data.
So
Bitcoin, what are you doing to me here? Jerks.
Today that we've reached this level.
We're not saying, no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and we're seeing progress, and we welcome that. But we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, interest rates, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around...
Was that a baby name?
Or holding
Tough
steady?
one.
Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions. And really what people are saying is, let's see how the data come in. We want to see, what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate, and now that we're getting closer, we have the ability to proceed carefully.
Thanks. Let's go to Steve.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only know it by its works, really. We can't, you know, the model and that the economy reacts, and again, that's another reason why we're moving carefully now, because, you know, there are lags here. So it may of course be that the neutral rate has risen. You do see people, you don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that you know, that the.
You're enjoying the
at
show,
this
please hit
moment
the
is
like
higher
button
than
and
that.
tell a friend
And
what
that,
we do here every
that's
Fed
part of
meeting.
the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters, thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistent.
Didn't
with
even say
2%.
his name.
You kind of did that in 2024, a little bit, 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment, and that's because we're seeing that rebalancing in other places, in, for example, job openings, and in the jobs worker gap. You're also seeing supply side things, so that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market. That can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right, in the median forecast, we don't see a big increase in unemployment. We do see an increase. And, but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, you know, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path has narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and you know, I also think you know, this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that. And we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. the fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Wow, the market did not like hearing that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence.
House plant wants to have his baby.
Continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say, sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say, if we get to that level. And then the question is, how long do you stay at that level? And that's a whole nother set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage
this year. And even then, it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Gina.
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously,
I think she wants his baby.
said things to the effect of next year, as we see inflation, kind of again to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. In the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Neil.
Thanks so much, Chair Powell. Neil Irwin with Axios. Wonder, how do you think about the question of whether the strong GDP growth that we've been seeing is driven by excess demand versus supply side factors, productivity, labor force
I'm hearing a
growth?
lot of Chappells
Relatedly,
today.
if
Sounds
GDP
like the
keeps
media
coming
likes him
hot,
again.
Even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's
if you're enjoying the show, please hit the like button, subscribe, and ring my bell.
Rebalancing
Ding,
the
ding, ding,
labor
ding,
market
ding.
and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them, but it's the strike, it's government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at, and so what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. To start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation, but that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain, and we'll be learning, I think, over the course of the next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time. A sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime age labor force participation moving up, where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Let's go to Chris.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Go to Mike.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5. What would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult.
None!
Forecasts are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last 3 readings are very, very good readings. It's only 3 readings. We were well aware that we need to see more than 3 readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the 3 buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But These are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast.
Was that him just passing the buck?
What justified not moving today, and what could justify moving in the future if you think?
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening becomes more equal. And I think the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we
Stocks sure look heavy here.
Find our way to the right level of restriction that we need to get inflation back down to 2%.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was what factors?
The base factors.
Base factors, okay. So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right, when you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
But would you feel more comfortable on the base effects that as those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So,
Oh, yeah, on the consumer, they're putting more and more of this on their credit card. The consumer seeing, you know, record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. You know, turning to consumer credit, you know, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, you know, during and after the pandemic. They're now moving back up to normal. We're watching that carefully, but at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks, and how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. You know, rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations.
Crypto now
It's
leading
mostly
us
about
lower.
other things,
Boo.
either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. You know, the common explanations that you hear in the markets kind of make sense.
Commodity currencies just
Kyle
look like
Campbell,
crap
American Bank.
here.
Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter rents, and supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages, and even if they want to move now, it would be hard because the new mortgage would be so expensive. Play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road, I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, you know, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed-rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed-rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for support...
Oh, they're bitch slapping crypto!
...are getting a lot tougher, a lot more...
Take that!
Thanks.
So what? I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with
Ethereum's such a great leading indicator.
Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that spending has held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. That could be, it could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question, your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed-rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible.
Man, that
Obviously,
Ethereum is
we'd like
coming
to
off hard
do
here,
that.
eh?
We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are, who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-income Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? I just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly were suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think
look at those commodity
households
currencies
are in good
getting
shape.
smoked.
Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
So is that it? Well, there you go, folks. What a train wreck, eh? Suppose we could take a quick boo at what's going on here in the markets before we let you go. I've got that video running somewhere. Let's see, where is it? There it is. Put you away. So interesting to see how Bitcoin and Ethereum really got smoked there. As soon as Ethereum started to roll over, look how basically that was the rollover on the pound, Swiss franc, euro, yen, Aussie dollar, and the Canadian dollar. Fascinating. I think the Canadian dollar got hit the hardest out of all the currencies here. It's a bit surprising. Stocks, they did not like what they heard there. Legacy broke to new lows, lower highs and lower lows. ES, I suppose NASDAQ should probably be next. NASDAQ tech stocks, they also broke to new lows. So S&P 500, sort of a mix of both, also broke to new lows. And the Russell 2000 small cap market also broke to new lows. I don't know whether you noticed or not, but it was really interesting to see when the Swiss franc and the Aussie dollar and then the Canadian dollar, like I said, really got hammered. Then as soon as they started to roll over, we saw that the gold got dragged down. And even things like copper were a bit weaker on the event as well. So I get the impression that people are expecting a weaker economy going forward. Out of all this, the one market actually that did do relatively well, of course, the US dollar index did relatively well. But I noticed that as we were chit-chatting away here and listening to all the Chair Powells and stuff, and I think we had Cotter counted 4 man babies. Actually, I think I heard more than that, but nonetheless, thank you for keeping count, Cotter. Maybe next next session that we do. 4 men and 2 women. Thank you, sir. I noticed that natural gas actually went and put in a W here while he was speaking. And usually natural gas prices do well in recessionary environments. Remember how natural gas prices took off there, and that sort of that post-sickness stupid nonsense that they did. Okay, and isn't that remarkable how that's even now? That's 3 years ago now. God, that's incredible how time flies. So a little disappointed to see the corn come off. Let's see whether our little fun little sim trade, did it get stopped out? I think it's still working, but let's go take a look. Where are we? Good old Bitcoin. Oh boy. Oh no, it got stopped. So we took a punch in the nose to the tune of $26.59. Jerks. Actually, I suppose with the breakdown here, we should probably just close this out. Actually, I thought I had the stop working, but we'll just close it out. All right. Does it want to close out? I do not want to close out. You will not get closed out. Sorry. Not interesting. I've been noticing this trading view trading function, this paper trading function. It doesn't really work very well. Isn't that interesting? Look at that. You can't move that. That's a bit odd. Let's see how bad gets. I should be stopped out. I should have exited, but trading view just won't let me. That's interesting. Well, we will see what happens. Suppose this probably, I mean, this was just a paper trade, so it's not really that big of a deal, but nonetheless. If we look at the bigger picture, so those were the 3-minute charts that we had chit-chatting away there while they were speaking. I guess he was speaking. Chappelle! This is more like half-hour charts, so a little bit bigger. You caught her. Cotter and Cole, there are our cheap seats. Who were the 2 guys in the Muppet Show from years ago? You guys remember those 2 guys? Muppet Show. I can't remember what their name were. I can't remember what their names were. Yeah, these 2 guys. I think this is Cotter and this is Cole. There you go. Stadler and Waldorf. That's great. I think that's perfect. You guys, because you guys both bring the funny. You're both hilarious. And you definitely have strong personalities to support your opinions. So if we can look at this whole thing from a little bit bigger perspective, what do we see? They actually sold the US dollar off into the announcement. So I think they were kind of expecting a bit more dovish of a Fed. And wow, what a violent reaction. What a great analogy of don't trust the market for 1 full hour following that Fed announcement, eh? Wow. There's the euro also too. They were bidding it up heading into the event and bang, bang, bang. See you later. Get your ass out of there. Euro did break to new lows here. So structurally a bit of damage there. Interesting how Japanese yen. I kind of got the impression that the Japanese didn't really get affected by that too much. And I don't know whether you've noticed like Japanese stocks and stuff lately. Jesus, they're stronger than sin. So I kind of noticed it through here. I didn't see a lot of weakness out of the yen. Yeah, there's the yen there, right? It's just sort of bumping along, held the lows, whereas everybody else just got bitch slapped here. And of course, as I said, and you heard me before we got this thing going, you heard me talking about substitute drama teachers and communism and stuff. It would not surprise me to see this Canadian dollar come under serious pressure here over the next while. So there is the Canadian dollar. And, you know, if anything, they always say, as the commodity currencies go, so go the commodities. Duh. That should be pretty straightforward. So we look at gold. Gold's got a bit of a head and shoulders top now. These are the 27-minute charts, thanks to Mr. Tesla. The silver market's got a bit of a rolling top, and crude oil, not really a top, but it did break. And as I had said there, and actually I don't have it on the screen here, but as I had said through the event, the one market that actually did surprise me a little bit was this natural gas actually firmed up a little bit. And actually it does have a pretty powerful little W working here. So let's see what the medium term charts look like. Nah, I mean, this unfortunately, it's not really cheap. Suppose that would be back against these lows, and it's not really expensive. It's just sort of sitting there going sideways here. So I don't know if there's a lot we can take out of that. But it was interesting to see that as he was speaking away, and I got the impression, like what I heard was, we don't give a fuck about employment right now. We don't give a fuck about how strong the economy is. We know that the economy is strong. What we really got to do is we got to get in front of this inflation problem. And from listening to him, I still think that there is an inflation problem. They don't feel like they're in front of the curve yet. That's what I heard. And I think that's, to a certain degree, why stocks really didn't respond very well. And interesting enough, you probably don't find that the gold market and stuff takes off, because keep in mind that the currencies lead everything. So if the Fed actually is perceived to have been done, then you'd start to see people say, well, there's no reason to own US dollars anymore. The Fed's going to be, cutting our pay, owning US Treasury bills and Fed funds and all that kind of fun stuff. So let's go put our money into work in Europe and Asia and commodity nations. People are going to build stuff. And you can see right across the screen here that that's clearly not the message to take from this. As I said, the one market that actually is hanging up here relatively well seems to be Japan. So stock's not happy. Let's go back to our here. Yeah, you can see it. It looks like the selling is accelerating too following the event. Like I said, this Canadian dollar, oh boy. Oh, wow, look at that. Is the market about to start smiling at us, folks? So this is a really, if you're watching this channel for the first time, you never really heard this before, take a screenshot of this and write this down. What are we supposed to think if you ever see the market starting to smile at you? Look how close we are to that smile kicking in here. So, and then what's interesting about this, now keep in mind, this is a 30-minute chart, still kind of like talking swing trading at best, not really position trading. But we could start thinking about fog and bombs and chaos theory. So, and actually, I guess this kind of makes sense, because it looks like the Canadian dollar just over the past couple of weeks has enjoyed a bit of a rally. My hunch is they're about to take back a big chunk of this. And actually, this is the very first trading strategy I ever learned from Kenny Roberts down out of, at that time, he was in Ojai, California, where the Bionic Woman lived. But I think he actually moved to Grants Pass, Oregon, and I've always wanted to live in Grants Pass. I always love that place. Such a nice, nice place. Got to get off my butt and move. I just have to figure out what the hell to do with Liam. But anyway, first rule, you should always ask yourself, what's the 50% rule? So where is 50%? And oh, what a surprise. There's 2.618. So this probably isn't going to be a huge collapse, but I definitely could see traders might even consider. In fact, I was talking to one trader even today that was like, oh, you know what? I just shoot for 1.5 to 1 risk rewards. That's going to be like a 1 to 1 risk reward. So I don't think I would really consider that as a viable use of my capital. So I don't know if this is actually a trade. I think I'd like to see the smile confirm. And I'd like to see a counter trend rally back up into reload zones and probably even, something like a nice test of this trend line. It looks like as I'm barking away here, has this confirmed? Looks like it's pretty damn close, eh? So on a clothesline basis, that's 74.36. And right now we are at 74.36. Exactly the same number. Dude, does it? Oh, the 74.360. Oh, what's this number? 74. Oh, wait a minute. Maybe I'm misreading this. On my old age. Need glasses. Oh, no, there we go. 74.36 even. So 74.35. Hello. Ding, 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 ding. So, anybody who's interested in shorting the Canadian dollar, you just got your signal that the trend just rolled over. So for me to be able to justify taking this trade, I think I'd have to see some sort of counter trend rally. Actually, this is where that concept of reload zones comes in really nicely. So if I wanted to hunt a trade, I'd probably be best to like do something like that. Notice, yeah, that makes sense. That window there, my reload zone short window, lines up nicely with the trend line kiss. So if I wanted to join this trade, I probably just got to be patient and hopefully we get like a nice top like that. Maybe, if anything, I wouldn't mind seeing this come down a bit more. I don't know, something like that. And then if I did somehow sneak in off of here and then risk against the old highs, and then use the 50% level as a target, there you got yourself a half decent risk reward. I like that. So anyway, interesting how the currency that's most under pressure right now is the Americans' little cousin to the north. That's interesting. Yeah, interesting too. I don't have it on the screen here, but it would be interesting to see what the peso's doing. Okay, so wow, look at that. Swiss franc just puking out here. As we said, the Canadian dollar coming off, Aussie dollar, the real structural top here. Kind of like the Swiss franc, this is like V top, V bottom. So I don't know whether there's a trade developing there, but I really think there is a trade developing on that Canadian dollar. Stock markets, no bids at all, anywhere in sight. Remember we had, like we said, off that 3 minute. Look at that beautiful little top there on the S&P 500. Look at that, eh? Just so this is a nice proxy for basically the broader US market. And what's fascinating about this, folks, if there's anybody still watching over on YouTube, our breadth indicator here has been very negative of the stock market for quite some time. And this was sort of the head scratcher because Bitcoin and the crypto market, of course, is super volatile. And it was pointing up here recently, but you can see this US market, it still looks ugly. There's no buy signal here from the breadth anywhere in sight. So are we going to start to see the stock market come off in earnest here? We could easily see that. Maybe get a little bit higher time frame look. What's that 4-hour chart look like? You can see we've actually come quite a ways here. This is going back to October of last year. So that's the 1-year range. And, remember, like I said, good old Kenny Roberts. At any given point in time, you should always be asking yourself, what is a 50% retracement? So that's there to there. 50% rule, 40.85. We're at 44.5. Is Brian predicting a 10% thumping in the stock market? Oh my God, you blasphemer. This is probably what our correction here this fall is going to look like. And actually 10% would probably be healthy. In the free video today, we looked at a lot of these big tech stocks, and you tell me. Of course, everybody already knows this. Who is part of the daily brief and watched the free video? Are insiders selling a bit of stock here? Yes. Where are the buyers? What the fuck? And then we looked at another darling, and this one's even funnier. There is a buyer here for Amazon. Believe it or not, there is a buyer. It's Mr. Bezos. Where is he? There he is. And he bought 1 share. That's hilarious. That's almost like a meme. That's so funny. And he's the only buy right across the board here. Everything else is a sell. So would it make sense for the stock market to come off a chunk here? Well, I think so. Probably also too, we could do like just a nice simple trend line, like that basing line right there. That to me looks like probably key support. So you can see that's a long way down. In fact, actually, we have one site member, Colin, and of course, trying to make him famous because he likes this zone 38.2 to 50%. And of course, if we think things like Wyckoff, Richard D. Wyckoff, this is basically a Wyckoff check level right there, 38.2, right on the nose. So anyway, you stretch it, you shape it, you cajole it, you talk about it. I don't know what other expression you want to use. I don't know whether I want to use that trend line. I kind of like using that one. You know what I kind of think would be cool here is to do a channel. So we'll go from that high to that high and then drag it down against the previous pivot. And I do believe that that is your trading range for now. Something along those lines. So interesting, that gives us a, actually I might even just keep this on the screen so we can watch for this. Looks like it gives us a date of November 8th. And actually that makes perfect sense because usually the market is very, very weak into the end of October, Halloween, right? All that kind of talk. And quite often you get sort of like, kind of like, I know who knows how this is going to go, but maybe something like this, right? And then we start climbing the wall of worry again. I could very easily see something along those lines. So stay tuned, folks. In fact, I would probably even, I'll throw that in the lounge. It's probably not a bad roadmap for us to use. And then also too, what we can do is do fog and bombs off of this range now. I don't know. I'm having fun just talking out my butt here. Are you guys enjoying this or should I just wind this up? Come on, you. There we go. Let's go chaos. There you are. Oh, nice. 2.618. Actually, a little bit dip below 50% level. Maybe that looks like that. Could be. Wouldn't surprise me. Something along those lines. In fact, actually, that would be totally appropriate because that would make an inverted head and shoulders, which would set us up for some sort of year-end rally. So, and actually, I don't know whether I think we were talking about it in the lounge as we were doing this. Of course, what's his name? Stadler and Waldorf. The question is, who's who? Whoever answers first will get the name. So Cotter, you're in the hangout here with me, and Cole's over on YouTube. The first person who claims a name here, I'm going to call you that for the rest of the day. You can see there's Cotter. And of course, we've got regulars all posting and chatting away here as we were going through this. I got to tell you, this is a really, really fun community to hang out in because these guys, they're really, really smart people. Actually, there's Johnny Chicken, man. He's been working with me forever. He's actually the guy that I always make reference to in these shows where I say he'll see the breadth indicator, and if the S&P 500 is negative like this, and I guess we'll just show you a quick boo. We have the crypto breadth here. And if he sees that these look different, you can see how crypto was pointing up there. And hell, it looked like we were pointing higher. I had that fun little sim trade going for you there. But if he sees that these are opposite, he just says, you know what? I'm not touching this. This has got trouble written all over it. And I got to say, Johnny, yeah, that's pretty damn good analysis. You're on smart cookie. Anyway, back to our story. Where are we here? Was that page? Well, it was maybe a different page. Yeah, it was over here. So Cotter, Stadler, is that how I'm going to remember you? And then Cole, Waldorf, Coldorf. Anyway, it's just so much fun coming into the TRI lounge and chatting with. We have a robust enough community now that we have just tons of people that are posting and great conversation all day long. And there's that guy. He's a funny character. So anything else we can sort of discern from this? I do really like this image. I'm going to put this in the lounge. I might even tweet it out later as a follow-up. In fact, actually, why don't we just do that now? Because we're not really in any huge hurry. Chris, you got to be somewhere here in the short term? Chris is driving the bus here, so if he's got to bail, then we got to wind this. All right. So where are we here? We'll go. Actually, that's what this is. I always keep looking for the Twitter thing now, of course. All right. So as you can see, we do have a Coinigy show coming up here this evening. So be sure to tune in for that. Hey, there's our buddy Crypto Traders Arena, Paul. I hope he's having a good time with his community. So where was I? Where did I do that tweet? Here it is. So we'll say, uh-oh. 10% haircut ink. I'll say incoming. That's a nasty looking chart, I'll tell you that much, by crackers. Anyway, we'll see. If this M does confirm, then you know we're heading lower. Right now, it's probably just simply still a trading range. But I'll tell you, the market sure didn't like what I heard from him. Let's circle back around. Yeah, see, it's still on its knees, eh? Wow, incredible. So that was the 27-minute charts that we had on this screen, right? With all these guys. Oh boy, look at that. Just sell. Oh, where's Bitcoin? Where is the corn? What are you doing, corn? Oh, here he is. Sell. I wonder if I got stopped out on this thing yet. Nope, still has the trade open. Way to go, TradingView. Oh, that's not a good sign. Jesus, it's like frozen. Look at that. Isn't that bizarre? I wonder why it's like that. I wonder what happened here. There it is. I don't know. I wonder how you kill that. I mean, we don't really need it open and it already failed, but look at that. You can't even kill the trade. Yeah, that just goes to show these paper trading functions are sometimes a little bit challenging on these sites. And FYI, I don't use the TradingView platform to trade real money. I have other brokerage accounts and all that kind of stuff. I think it's a little dangerous to use TradingView to trade, to be honest with you. And I heard another guy also today say that he actually likes to have a completely different platform open for all of his trading on a completely different computer. And frankly speaking, that's not such a bad idea in this world. Okay, let's go back to our conversation here. So Canadian dollar as a commodity proxy flashing a major topping sign there. I think I would still consider that a pullback. Swiss franc, just insane volatility. It is breaking key support there though. As we talked about with the stock market, looking pretty damn heavy. And interesting how NASDAQ is sort of leading the charge. Look at old economy is hanging in there against those lows, but new economy just broke down with the S&Ps. And look at the small caps. Oh, the small caps are getting smoked too. So ain't no love in the stock market out of all this. And interestingly enough, this is probably the reason why. You tell me. Are the bond people happy coming out of this event? Or are they a little bit unhappy? These are bond prices. And of course, yields move in the exact opposite direction. You tell me. I get the impression interest rates are heading up, not down, up. And of course, these are all structural patterns. So that means you can start doing things like foggy buggies. And you can see the rate of change of the 2-year. This is sort of like the market's vote on Fed funds, the short end of the curve. That's coming off a lot faster, right? You could probably do like percentages here. So you can see here, this is a move from 0.5% down to basically flat line. This is 0.15% down to negative 0.3. That's about the same size drop, believe it or not. This is from basically 0 down to minus 35. That's actually a little bit less, I think. And then this is, what the hell number is that? I don't think you can do that when it's in the percentage mode. Oh, there. Oh, I won't show. Knucklehead. There we go. Okay, so beautiful M top, right? If you were a bond trader, oh my goodness, what a signal there. And that was plus basically, well, there's 0.1 right there, all the way down to minus 0.13. I don't know how to interpret that. That is a fairly sizable move, but I think on a percentage basis, actually, this is less than these moves. Still no bottom in stocks. Jesus, they're just selling this thing, eh? Jeez, incredible. All right, no stop bottom in stocks, no bottom in bonds. And ironically enough, the only thing that's actually doing relatively well here, gold has come back down. Now, seeing the way that the Connect Buck and actually the Aussie dollar now, look at that, Aussie dollar's now breaking through these support lines. My hunch is this gold's got to go through these support lines. You can see the Swiss franc. Remember we said Swiss franc's a great proxy on the gold market. You can see how they blasted through these lows here this morning. So I can't see how gold can hold these lows. And they always say the currencies lead the commodities. Canadian dollar is more of an energy play. So if the Canadian dollar is emming out and breaking down, that tells me crude oil is probably going to em out through these lows and break down as well. Good old Bitcoin lost it, puked out. We got stopped out on our fun little bot. Ethereum really gave it up there. And remember, we had said at the very beginning of this broadcast, I really like Ethereum as almost like a leader of all of these risk assets. I get the impression that that's what Mr. Vitalik's sort of supercomputer crypto has become now, believe it or not. And as a proxy on the junior market, Litecoin sort of following suit, also breaking down. So the total market cap, here's the total crypto market. Interesting how we have this play against these highs here. So my hunch is probably going to have a play against these lows. And then, the question, if we look at like a 4-hour chart, is this thing, does that look uppy or downy? It's kind of a sloppy M. I wouldn't even be surprised if we find some support against that recent low, like I was saying. Then we counter trend rally and make some sort of head and shoulders. And then if that head and shoulders does break down, then get ready. The fireworks will ensue. I don't know. I mean, this is a 4-hour chart. If anything, I'd be curious to see how it's going to act against like this key low here and that high there, and then all these lows down in here first. Anyway, this is just a line chart. So. All right, so I think that's basically your summary. And like I said, in the Coinage show that we're going to do later on this evening, of course, we'll have a really detailed conversation about what we're seeing here. And I suppose the last thing to look at, what is the US dollar index itself doing? They always say US dollar index is sort of your risk on, risk off proxy. And quite often what ends up happening is the US dollar starts to come off ahead of the FOMC announcement. And then on the announcement, you get some big ass reversal. And it looks like to me they did the same thing. So notice how every time we come back against 13 EMA, my fast moving average, the market firms up. And that's exactly what just happened there. The trend in the US dollar actually turned back up there middle of August, I guess, well, beginning of August. And we've just been relentlessly trending higher here since. Higher time frame objectives. It looks to me like the unwinding of this bull, of this bear, has played itself out. Obviously, that's a pretty busy chart, so it might be a little difficult to see that. We maybe just do a nice clean chart here to finish this off. Ooh, interesting. Coinbase. Ooh, double top breakdown. Look out. Probably, well, this is a stock show, so I guess we can do that. Actually, Chris showed me how something new here today, which is so cool. The drawing panels. Turn that on and off. So anyway, we got that there. So first things first, what's a 50% rule? I'll throw on all the fibs here just so we can get a pretty good idea. So interesting how the pullback in Coinbase was right to that 50% level. Consolidation. Now, is this some sort of AB equals CD? Uh-oh, it might be. Don't like the look of this little double top, so we can do little fog and bombs just off of this level, and this little fog and bomb will trip up the bigger one. So interesting how 2.618 is right against those lows. So if that's the case and it fires, then that means we can do chaos theory down here. And oh, what a surprise. Brian's favorite fib, 78.6. There it is, 2.618 against this funny low here. And also notice too, there's a unresolved gap here. I don't think this has been filled in yet. So, I mean, there's huge gaping gap. Look at the size of that one. That's what she said. But then there's also this gap here. Notice that that's not been filled in yet either. And of course you got this really weird price action. You know, they always say V bottoms need to be tested. So I wouldn't be surprised if we actually have to come down and test this low. So writing's on the walls here. That does not look good, my friends. This is a crypto stock. Oh, and also too, notice here, 2.618. David O, and actually, just to give you an idea, it's stock market, so I suppose we can talk about it here. You want to see something that David was buying, and I was like, God damn, I got to buy that. I couldn't believe how pretty it is. Not this stuff where insiders are dumping like crazy. What are we interested in now? We're interested in, of all things, and it almost makes you sick to your stomach in a weird sort of way. Where is my stock market? Yeah, okay, it is here. Oh, so I guess we'll use this. But look at the difference. Like this is kind of ME and really no W's. There was a cute little W that tried to fire, but looks like they're taking that back. Terrible trade location. Ideally, of course, we want to be seeing trade location on down to the bottom end of the ranges. But look at this little thing. Jesus, look at that chart, eh? God damn. So this is what's called an Adam and an Eve pattern. And if I want to buy something, I want the chart to look like this. So I did go in and buy some of that today. Jesus, that looks so good. And here's another special treat for you. This is one that we're watching. Came out of the meeting yesterday. Can we get a double bottom here, a W on the other side of this trend line? Lots of room to go to the upside. Huge gaps up top. And this is one of these AI plays. But notice it's having trouble putting in the double bottom here. So I won't pull the trigger on that just yet. So, okay, so back to our conversation about coin here. Looking up kind of heavy. And I could see us have to work our way right back down. And of course, there is a gap opening right there. And there's also a gap right against these lows. So this is probably another anecdote. I think I've shown you guys, and we'll talk more about this in the Coinigy show tonight, that I'm not overly excited about crypto now over the next 6 months. And given what you just heard from Mr. Powell, I don't think it's actually really well. I mean, it's going to be around SBF and all that nonsense and stuff. But if the U.S. dollar here is cranking higher, and things like the euro and the commodity currencies are all getting wiped out, and the stock market's getting wiped out, I don't think it's really directly crypto related. I think it's just that crypto is now part of the asset investment universe. It is a risk asset, in my opinion. And we are still a million miles above cost of production. So it's not like you can argue that there's intrinsic value at $27,000. I don't think there is. And actually, there, Stadler, did we call it? Is it Cotter Stadler? I think that he is. Mr. Stadler, of course, would debate endlessly over the cost of production for Bitcoin. But we won't open up that can of worms. But, don't be surprised if Cotter goes, I don't know, Brian. But I did post out recently that even Joey Diamond over there at JP Morgan says that the cost of production for Bitcoin is around $13,000. So this is where the public, who really doesn't understand any of this stuff, is going to get absolutely smoked. I mean, I kind of think there's a head and shoulders top working here. And if that's the case, of course, measured moves, that takes us down into sort of the, at the very least, come down and test the low end of the range. But I got a sneaky suspicion that they're going to want to wash these lows. And if Joey is correct and industry concedes that, somewhere between 10 and 15,000 is sort of value for Bitcoin, well, it's not really that Bitcoin is going to zero. So I don't think the case of that is even remotely plausible. It's more like they're just going to knock the speculative fluff out of price here that's been built in. So just try and keep that in your mind. And remember, 2020, that's exactly what they did here. It's almost identical. They bid the market up off a double bottom, and they had to bring the market back through that whole sickness nonsense, literally right back down against the lows. And beautiful Wyckoff check, 88.6. I used to work with this guy, Kevin, who basically had his bid working at that 88.6, and he got an absolute gift when everybody and their brother started to panic and puke out. So can you be a Kevin? That's entirely up to you. So anyway, okay. Why don't we leave the broadcast at that? PMA for the win. Slow and steady wins the race. Great analogy. Probably shouldn't trust what you see in the market until a full hour following the Fed announcement. And it looks to me like they're in the selling mood for the time being. So if anything, if crypto is a leading indicator and you are a bull, you'd like to see some W's come in here and sort of stop the bleeding. What time is it? Oh, actually, stock market is now closed. So nothing left to do other than the shouting. As my old one of my old clients who actually used to be, he used to trade when they actually had runners on the floor in the Vancouver Stock Exchange back in the 1920s. And then as soon as the closing bell happens, then all the fist fights break out on the floor as people argue over whether they got fills or not. So, all right, everybody. Have yourselves a great day. PMA for the win. Slow and steady wins a race. Don't take no win nickels. Be sure to tune in for the Coinigy show in about 4 hours or so. And have yourselves a great rest of your day. Bye for now.